October 1929. The stock market is collapsing. Millions of Americans are watching their life savings evaporate in real time. Families who were middle class last week are standing in bread lines today. By 1933, 25% of Americans will be unemployed. Children will starve. Farmers will lose everything. The Great Depression will destroy an entire generation. But not everyone lost money in 1929. This man made $100 million during the crash. In today's money, over $1.5 billion in a single year. While America burned. This man was the chairman of one of America's largest banks. When his bank's stock collapsed, destroying his shareholders, he made $4 million because he'd secretly bet against his own bank. And this man? He sold $650 million worth of bank stock to ordinary Americans at $340 per share. 4 years later, that same stock was worth $34, a 90% loss. But he walked away rich. These three men didn't just survive the Great Depression. They orchestrated it. They saw it coming. They positioned themselves perfectly. And when the crash destroyed millions of lives, they walked away with fortunes that would make them billionaires today. And here's the terrifying part. The exact same thing happened in 2008, and it's being set up to happen again. Right now. The playbook hasn't changed. The names are different, but the game is exactly the same. By the end of this video, you'll know how they did it. You'll know why they were never punished. And you'll know how to spot it happening again. Because it is. This is the story of the bankers who wanted the Great Depression. Because they'd already positioned themselves to profit from it. Let's expose them. Let's start with the most brazen of them all. Jesse Livermore. They called him the Boy Plunger. And by 1929, he'd already made and lost several fortunes through what we'd call market manipulation today. Jesse Livermore started trading stocks at 14 years old. By 20, he'd made his first fortune. By 25, he'd lost it all. This became his pattern. Make millions. Lose millions. Repeat. In 1907, he made $3 million shorting the market during that year's banking panic. While J.P. Morgan was trying to save the system, Livermore was betting it would collapse. He was right. But here's what made Livermore different from just a lucky trader. He understood that markets were manipulated because he manipulated them. Livermore pioneered techniques that would later be made illegal: pools and raids. He'd coordinate with other wealthy traders to artificially drive stock prices up or down. They'd spread rumors, place strategic trades, and manipulate the market. Once the public followed their lead, they'd reverse course and profit from the chaos, reading the tape. Livermore was obsessed with the stock ticker tape. He could read patterns that revealed when other big players were buying or selling. He'd position himself ahead of their moves. Short selling at scale. Most people bought stocks, hoping prices would rise. Livermore borrowed stocks, sold them high, then bought them back cheap when prices fell. He made money when stocks crashed, which means he profited from other people's losses. If Jesse Livermore was brazen, Albert Wiggin was something worse, a traitor to his own institution. Albert Wiggin was the chairman of Chase National Bank, one of the largest and most prestigious banks in America. People trusted him. Shareholders invested based on his leadership. Depositors believed their money was safe under his watch, and while they trusted him, he was secretly betting against them. Here's how Wiggin's scam worked. In the late 1920s, Chase National Bank stock was riding high. The bank was lending aggressively, stocks were booming, and Chase shares were trading at peak prices. But Wiggin knew something his shareholders didn't. The bubble was going to burst. And when it did, Chase stock would collapse. So what did he do? He created shell companies, secret corporations that nobody knew he controlled. Companies with names like Shermar Corporation, Merlin Corporation, Klingston Realty Corporation. These weren't real businesses. They were just legal entities he controlled in secret. And through these shell companies, Wiggin began shorting Chase National Bank stock. Let me repeat that. The chairman of the bank was betting that his own bank's stock would crash. Think about how sick this is. Wiggin was in every board meeting. He knew the bank's real financial condition. He knew about the bad loans. He knew about the risky positions. He had information that shareholders and the public could never access. And instead of protecting his bank, instead of warning shareholders, instead of doing his fiduciary duty, he positioned himself to profit from the bank's collapse. When the crash came in October 1929, Chase National Bank stock plummeted. Shareholders, many of them ordinary Americans who'd invested their life savings, lost everything. The stock went from $5.75 per share in 1929 to $57 by 1932, a 90% loss. But Albert Wiggin? Through his shell companies, he'd shorted 42,000 shares of Chase stock. When the stock collapsed, he made over $4 million in profit. That's nearly $70 million in today's money. For 3 years, nobody knew what Wiggin had done. The shell companies kept his trading secret. He continued as chairman of Chase, collecting his salary, attending meetings, pretending to be a responsible banker. Then, in 1933, Ferdinand Pecora, a Senate investigator, subpoenaed Chase's records. And he discovered the shell companies. He discovered the short positions. He discovered the betrayal. Wiggin was called to testify before Congress. And under oath, he admitted everything. Senator, did you sell short the stock of your own bank? Wiggin: I did, Senator. While serving as its chairman. Wiggin: Yes, Senator. Did you see anything wrong with that? Wiggin: No, it was entirely legal. Entirely legal. That was his defense. And technically, he was right. There were no laws against insider trading in 1929. No laws against shorting your own company. No laws preventing chairmen from destroying their shareholders. So Albert Wiggin faced 0 criminal charges. The public was outraged. The Senate investigation exposed him as a traitor. His reputation was destroyed. But his wealth? He kept it. All $4 million in illegal profits? He kept it. And Chase National Bank? They asked him to resign, but they let him keep his $100,000 annual pension, a massive sum in 1933, equivalent to over $2 million per year today. So Albert Wiggin retired to his mansion, lived comfortably on his pension and his profits, and died wealthy in 1951. He destroyed thousands of shareholders. He betrayed the institution he was supposed to protect. He profited from the worst economic collapse in American history. And he got away with it. But if Wiggin was a traitor, Charles Mitchell was something even worse. A con artist operating at the highest levels of American finance. Charles Mitchell was the CEO of National City Bank, which today is Citibank, one of the largest banks in the world. They called him Sunshine Charlie because of his relentless optimism about the economy. Even as storm clouds gathered, Mitchell kept telling everyone, "Everything is fine. Keep buying. The market can only go up." But privately, he was selling. Mitchell understood something crucial. The real money isn't made by investing. It's made by selling investments to other people. So in the 1920s, Mitchell created something unprecedented, a nationwide sales force of over 2,500 people whose only job was to sell stocks to ordinary Americans. These weren't investment advisors. They weren't there to help clients. They were high-pressure salespeople with quotas and commissions. Mitchell trained them in aggressive tactics. Go door to door, target middle-class families, Convince them to borrow money to buy stocks. Push National City Bank stock especially hard. Don't worry about whether it's suitable for the client. Just sell internal training memo. Forget about the customer's needs. Your job is to move product. The more you sell, the more you make. And what were they selling? National City Bank stock. At inflated prices. To unsuspecting Americans. In the late 1920s, Mitchell's sales force pushed $650 million worth of National City Bank stock. They sold it at prices around $340 per share. Mitchell himself was giving speeches. National City Bank is the strongest bank in America. This stock will make you rich. Buy now before it's too late. Meanwhile, Mitchell and other bank insiders were quietly selling their personal shares. They knew the bank was over-leveraged. They knew bad loans were piling up. They knew the crash was coming. But they kept selling to the public anyway. By 1933, National City Bank stock had collapsed to $34 per share. The people who bought at $340 lost 90% of their investment. Life savings, gone. Retirements, destroyed. Dreams, shattered. But Charles Mitchell, he'd sold at the top. He walked away, wealthy. But it gets worse. In 1929, Mitchell realized he owed over $3 million in taxes on his profits. So he came up with a scheme. He sold stock to his wife at a loss, creating a tax deduction. Then, after the tax year ended, his wife sold the stock back to him at the original price. It was a fake transaction. His wife didn't actually buy anything. It was just a paper shuffle to avoid taxes. And it worked. Mitchell avoided paying $3 million in taxes, equivalent to over $50 million today. In 1933, after the Pecora hearings exposed Mitchell's schemes, the government charged him with tax evasion. The trial was sensational. Evidence showed the fake stock sale to his wife, internal memos, proving he knew stocks were overvalued. Training documents showing salespeople were told to push products regardless of suitability. His personal stock sales at peak prices while telling the public to buy. Senator Carter Glass, co-author of the Glass-Steagall Act, said, "Mitchell, more than any 50 men, is responsible for this stock crash." But Charles Mitchell was acquitted. The jury found him not guilty of criminal tax evasion. However, the government won a civil judgment. Mitchell had to pay back $1.1 million in taxes plus interest. So unlike Wiggin, Mitchell actually faced some consequences. But did he go to jail? No. Did he lose his wealth? No. He paid a fine and moved on. By 1935, Mitchell was back in banking, serving as chairman of Blyth & Company. He died wealthy in 1955. So we have three men, Jesse Livermore, Albert Wiggin, and Charles Mitchell. Between them, they made well over $100 million while America starved. They manipulated markets, betrayed shareholders, and conned ordinary Americans out of their life savings. And they all got away with it. Why? In 1929, almost none of what these men did was illegal. Insider trading? Not illegal. Short-selling your own company? Not illegal. High-pressure sales tactics? Not illegal. Market manipulation through pools? Not illegal. Using shell companies to hide trades? Not illegal. The securities laws we take for granted today, the SEC, insider trading laws, disclosure requirements, didn't exist. They were created after the crash, partly in response to what these men did. So, technically, Wiggin was right. What he did was entirely legal. But just because something is legal doesn't make it right. These men weren't outsiders. They were the system. Mitchell ran one of the biggest banks in America. Wiggin ran another. They had relationships with politicians, regulators, media owners. They funded campaigns. They sat on powerful boards. When you control the system, the system doesn't punish you. In the 1920s, most major newspapers were owned by wealthy businessmen with close ties to Wall Street. The media largely celebrated these bankers as geniuses and success stories. Even after the crash, coverage was often sympathetic. Tragic mistakes were made, rather than criminal fraud was committed. The Pecora hearings in 1933 exposed the truth, but by then, millions had already lost everything. When the public demanded accountability, these men pointed fingers elsewhere. Mitchell blamed external economic forces. Wiggin blamed market conditions beyond anyone's control. Wall Street blamed speculation by unsophisticated investors. They reframed their crimes as victims. We all suffered from the crash. Except they didn't suffer. They profited. Now, here's the scary part. The exact same playbook was used in 2008, and it's being set up again right now. In 2008, Goldman Sachs and other major banks were selling mortgage-backed securities to their clients. Pension funds, cities, foreign governments. They marketed these as safe, high-quality investments. But internally, Goldman Sachs was shorting the same securities. They were betting these investments would fail. They knew they were selling garbage, and they positioned themselves to profit when it collapsed. Sound familiar? It's the Albert Wiggin playbook. Sell toxic assets to clients while secretly betting against them. Investors like Michael Burry, Steve Eisman, and John Paulson saw the housing bubble and took massive short positions. When the crash came, they made billions, just like Jesse Livermore in 1929. And what happened to the bankers who caused the crisis? A few firms paid fines, but no executives went to jail. They kept their bonuses. They kept their wealth, just like Mitchell and Wiggin. Right now, in 2025, we're seeing the same warning signs. Massive valuations, stock market at all-time highs despite economic uncertainty. Tech stocks trading at absurd multiples, speculation in crypto, meme stocks, AI companies, insider selling, CEOs and executives selling billions in personal stock, hedge funds taking defensive positions, smart money moving to safety, public encouraged to buy, financial media pushing retail investors to buy the dip, banks offering easy credit for speculation, influencers hyping risky investments. Does this look familiar? It should. It's the same setup as 1929 and 2008, and every crash before. The playbook never changes. Create a bubble with easy money. Sell overpriced assets to the public. Insiders sell at the top and take short positions. Crash the market. Profit from the collapse. Buy up assets at pennies on the dollar. Wait for recovery and do it again. Jesse Livermore, Albert Wiggin, Charles Mitchell. These three men represent something deeper than individual greed. They represent a system designed to transfer wealth from the many to the few during moments of crisis. The Great Depression wasn't just an economic tragedy. It was engineered, not by accident, not by inevitable market forces, but by men who positioned themselves to profit from suffering. Livermore made $100 million while families starved. Wiggin bet against his own bank and won. Mitchell sold worthless stock to ordinary Americans and walked away rich. And the system didn't punish them. It protected them because they were the system. This is how wealth transfers happen, not through hard work, not through innovation, but through manipulation, inside information, and positioning yourself on the right side of a collapse you helped create. Today, the names are different. The tactics are slightly more sophisticated. But the game is exactly the same. So pay attention. Watch for the warning signs. See who's selling while telling you to buy. Notice who's positioned to profit when the next crash comes. Because it's coming. It always does. And when it hits, some people will lose everything while others make billions. The only question is, which side will you be on? Thanks for watching. If this opened your eyes to how the system really works, share it with someone who needs to see it. The truth about the Great Depression isn't taught in schools, but it should be. Because those who don't learn from history are condemned to lose everything when it repeats. And it always repeats.